Now recording the class. And we have a chat question. Kathy Campbell says, I have you on the computer, but I'm trying for phone as well. Okay. Thank you, Kathy. Anything I can do to help you on that, you let me know. All right. So that's where we stand heading into this evening. We're going to look at 3 problems tonight, 10-2A, 11-1A, and 13-2A is our problems we're going to look at tonight from the textbooks. We're going to do those. Those are perfect examples of the work. We'll have a little presentation before each problem about the topic of the chapter. Hopefully you have had a chance to read some of those pages I gave you last week. And you can be refreshed in our discussion tonight about these problems. Before I move on, does anybody have any administrative questions or any concerns? Very good. So let's begin. Oh, we have a chat question. Oh, okay, Kathy, hope everything works out. Thank you. Our midterm examination was five questions. Each evolved around the transacts. 3 of the questions were involved around one company and your transactions to record each one of those sectors of the accounting cycle. The 4th question was concerning itself with merchandise accounting. And the 5th question concerned itself with inventory valuation by the 3 methods, Fifo, Lifo, and weighted average. The points for each problem were 20 points for each question. One of the key parts of it, if you made a mistake in your original journal entry or your adjusting entries, naturally your points were taken off for that. But if you did not do anything different to your financial statements and just proceeded with that incorrect entry, you didn't lose any points in your financial statements going forward. But you did get points taken off if you didn't have the proper heading in your financial statements or it's set up properly. But everybody did a pretty good job. Where we had a little bit of taking off of is in the inventory valuation, and that was a rather confusing, in some respects, problem. And I didn't take into account too much weight to that problem. But that's primarily where the areas of trouble were. But I'm going to go over some of the key parts and how I graded this so you can see it. Again, we will not have a question like this on our last examination in a couple of weeks. This section of the course is now over, so you don't have to worry about it. You would have to worry about it if you are an accounting major and you're going to proceed with further accounting studies, but I don't think we have any accounting majors in our class. So the first area that I made sure that you were doing is just the proper format of journal entries, a ledger, and I took it in any shape or size. But my first real hint of how you were doing was taking a look at the trial balance of Reggie Dunlop Company. I was looking for $189,800. If you had that, that means your journal entries and general ledger were posted properly and you're in good shape. And in almost every case in our class, you all were in pretty good shape. And then you went to the adjusting entries. The adjusting entries to adjust the accounts with certain things happening with the prepaid, supplies inventory, depreciation expense, which we learned tonight how to calculate, your accrual of salaries, and the receiving of a receivable. So then we have an adjusted trial balance of $192,550, and that led into the financial statements of the income statement with a net income of $27.25, an owner's equity statement of owner's equity balance of $180,725, original investment, plus net income minus withdrawals, and the balance sheet, statement of assets, liabilities, and net owner equity balance. From that, we went on to close the books, closing all the temporary accounts of revenue and expense and withdrawals. The revenue and expense accounts are closed to the income summary account, and then that is closed out with the net income heading into capital. And then we asked to do a final trial balance of post-closing showing 182,325 of all the asset liabilities and the net in the capital account to be moved forward into the next financial year. So that's what we're looking at in the first three questions. So this Reggie Dunlop company was worth 60 points. Proper headings, balances, that was the key thing that I was looking for. Secondly, then we had the merchandise inventory calculation, where we were asked to record certain aspects of inventory with discounts, with the a variety of turning, when you sell a revenue, you have to report the cost of goods sold. Everybody, again, did very well on this. And we had a second part of this of taking a look at the income statement for a merchandising concern with various details left out, and you had to puzzle it out, look at the various problems. And the bottom line of this for the Corman Company was they were having a net income in year one of $3,000 and a net income in year two of $2,500 with the various segments filled in. And again, all of you did very well on that one. And then that was, again, 20 points for those two parts. And then the final section was inventory valuation, determining the ending inventory under Fifo, Lifo, and weighted average. So again, we all did very well. The only problem we have a little bit is in the weighted average. Most of that was interpretation. Some of you did a little bit different method than I would have. I didn't take too many points off for that because your interpretation was not what I was looking for, but it was pretty good, pretty close. But I was taking the overall amount invested, dividing it by the number of units, and to get a net weighted average cost per unit of 1778, multiplying that times the ending units, and I get 2667. But we were off just a little bit on that, not too concerned. Everybody had a different interpretation of that. That was fine. But again, for 6 chapters, very good work. 7 chapters, very good work. And I appreciate all your efforts, and you did a very good job. Some of us were a little bit, was trying to find pieces of a puzzle, trying to find all your answers and how you had your financials or your spreadsheets set up or your Word documents. But that's okay. I was able to sort it out, and everything was fine. Going forward, I urge you to not use word processing to record accounting. Excel spreadsheets are a lot easier than PDF or word processing. Keeps everything in nice, neat order. It's a way of calculating them in equations, a little bit easier. But again, if that's not your cup of tea and you like using Word or a PDF, that I don't have a problem with that. Down the road, if any of you take any more advanced accounting courses, your professor might have something to say about that. But in my class, how you present it is up to you. As long as I can follow your work, I have no problem. So we now have all your cumulative averages now posted to Blackboard. If you go to that front page of Blackboard, you can see your average in class up to this point in time. And let's bring that up. So if I look at my Blackboard account over here in the report card, you would see a grade for your course up to this point in time. Naturally, your grade is your course or Blackboard is a little bit different than mine. Let me just change that to a student view. There we go. And there's your front page where you'll see your grade, and it might be so far an A. All right. You click on that grade and you can see all the postings of what makes up that A and where you stand. All right. There's no A pluses, remember, in this class and at the University of Laverne. We only have grading of A, B, C, and plus or minus or whatever. But there's your cumulative grade. That's all of your grades posted up to this point in time. I urge you in the next couple of days to look at that, make sure you understand it. If you have a problem with that, please let me know either in our office hours on Thursday night or sending me an email or contacting me at any time during the day. Be more than happy to explain that grade to you. But that's where you stand heading into the last 3 weeks of our course. Now remember, we have roughly 40% of your grade still remaining, 40%. So we have 45%. So roughly half of your grade is still remaining. So, but that gives you a good idea where you stand, what you have to look forward to. And if you have any questions or concerns about that, please let me know. All right. Any questions about this right now? You guys are doing too well. You don't have any questions. So that's not a bad thing. All right. Let's get out of this. And let's go to this. Excuse me. I don't see anybody tonight, so it's a little intimidating for me when I don't see. Well, I see Barbara. She's there, I think. I think she is. But let me bring this up. Okay. Chapter 10. Depreciation. Depreciation is expensing an asset over its life. And remember, this is accounting. Many times during what we're used to is that you purchase an asset and it usually grows in value over its life. All right. It grows in value, like real estate. Even a quality car or a quality piece of asset usually increases. But in accounting, we're allowed by the tax code to expense the asset over time. And what we can expense is the cost of the asset over a period of time. Why does the IRS let us do that? Because we know in most cases that the book value of an asset will be reduced over time because we're using it. We're beating the hell out of equipment. We're using up a building. We're using a computer system. We're beating up a phone system. It loses its value because we're using it. And also there's probably replacements out there that have a greater value. So we are allowed by the Internal Revenue Service Code is to expense that asset over time. All right. You have on your balance sheet the acquisition cost of the asset. And then as we depreciate that asset, as you did in the midterm, you book that into a depreciation expense account and accumulated depreciation, where you keep track over the life of the asset what you're depreciating. So that's a key thing. And when you all take business finance from maybe Professor Hassey this summer, we use depreciation as a way of determining the value of an asset over time, and it's considered positive cash flow. You're expensing an asset, but you're not writing a check. You're allowed to expense it by a journal entry, but you're not writing a check to Mr. or Mrs. Depreciation. And so that's an interesting quality that we'll talk about in business finance this summer. So what or how do we depreciate? Because we're in this class we're accountants. So we have to record the depreciation over time of an asset. Right? Well, how's that gone about? Well, there's 3 main methods talked about in the text. And you have to need to know these: straight line, units of production, and declining balance. The IRS lets us do, just like it did in inventory, it allows us to do FIFO, Lifo, weighted average. It gives us various methods that we can select to do that. Now, if we decide to change the method, it will have to be at the end of a fiscal year, and then we can make updated financial or updated depreciation schedules if we decide to change the method. You can't change the depreciation method midway between a fiscal year. So our job in Chapter 10 is to understand straight line, units of production, and declining balance. Okay, well, let's take a look at this in the context of the textbook. We have a piece of equipment that cost us $10,000. It has a salvage value of $1,000. In other words, that's what we think its value will be at the end of its life, which here the life is 5 years. Okay. That's why you're sending me an email. Okay, that's fine. Thank you, Vince. So we depreciate it over a certain amount of time. Now, this is a weird concept. In this example, this piece of equipment has a 5-year life. What does that mean? That's how long the IRS determines that life. Now, you can own that equipment for 15 years, 20 years, 30 years, but it only has a depreciable life of 5 years. That's how long you can depreciate it. That's an interesting concept. I think a lot of you might work for companies. I wish I had one here. If you look at all the assets of your company where you work, on each computer, each piece of furniture, each chair, somewhere on that chair is a little barcode or a little symbol, a little code. That's the code to relay that to whatever depreciation schedule the company is keeping track of that asset. It's how they keep track of all their assets of a company. Why is that important? Because they can expense those assets over the course of their depreciable life. So this asset here has a depreciable cost of $9,000, a life of 5 years, and it expects to produce or use during the course of those 5 years 36,000 shoes. Now you might want to ask, who in the hell figures that one out? Well, again, the IRS and the company, usually the company's CPA or public accounting firm, will determine that based on historical use of similar machines, and they determine that. So what is the straight line method? Here it is right here. For this particular product, the straight line is $10,000 minus the salvage value divided by 5 years. In other words, we will depreciate $1,800 a year for the 5 years of this asset's life. The entry every December 31st will be debit depreciation expense and credit accumulated depreciation. Kind of like exactly what we did in the midterm, but now you have to calculate what that amount will be. All right. Straight line is pretty easy. And to be honest with you, about 60% of most companies use the straight line method. Why? It's simple to figure out. It's not very complicated, and it's easy to manage. So the straight line method, it's simply cost minus salvage divided by the life in years to come up with your yearly depreciation. Pretty easy, not too difficult. And here's how it'll appear on the balance sheet. The cost of the machinery, and this is after 2 years, we've accumulated $3,600 of depreciation has been expensed up to this point in time, and the book value on the ledger would be the cost minus the depreciation, $6,400. So straight line depreciation, if it's 5 years, you're depreciating 20% a year. That's how it works out. If you're depreciating something over 10 years, you're depreciating 10% a year. That's how it all works out. That's why it's called straight line. Then we have the units of production method. All right. And this is based on how many units you produce from this asset every year. Straight line has nothing to do with it. Units of production is you take the cost minus the salvage value, just like we did in straight line, but then you divide it by the anticipated amount of units you're going to be producing during the life of the asset. Then you take that rate, that per depreciation per unit, and multiply it times the actual number of units during a given year. And that's how you get your depreciation. Let's take a look at that. So in the case of this particular problem, the cost is $10,000. We minus out the salvage value, and we divide that by 36,000 units, our anticipated units we're going to produce. That comes out with a rate of 25 cents a unit over the 5 years. So let's say in the first year they produce 7,000 units. We would take that actual units, 7,000, times that rate that we predetermined, and we get our depreciable amount every year. So it's based on units produced times the predetermined rate. Units of production. So that units of production will be driven by how many units you produce every year, and that's how we get our depreciation record. Again, not too difficult. All right. Then we have the most confusing of the depreciation methods. And as you guys know, in accounting, there's always something that's a little bit confusing. It's called double declining balance. In other words, you're going to depreciate more of the asset in the early years and less depreciation in the later years of ownership. All right. The double declining balance is determined by taking the straight line rate, which in this case, we know it's 5 years, that's 20%, and we double it. In other words, it's now double declining means our rate is now 40% depreciation. So for the first year, we do not include the salvage value. We take the entire cost of the asset, $10,000, and multiply it times the 40%. So notice how high our depreciation expense is for this method. We're going to depreciate $44,000 in the next year. But subsequently, then we take the balance, the book balance at the end of the first year, which is $6,000, the 10,000 minus the 4,000 depreciated in the first year. And that $6,000 is now multiplied by 40%. And we get $2,400. The second year depreciation. That brings our balance down to $3,600. Year 3, 3,600 times 40%. We get, notice how the depreciation mark is declining, $1,440. That brings us to 2,160 times 40%, 884. And then in that final year, we just take whatever's left over so we can end up with an accumulated depreciation of 9,000, which is our anticipated salvage value of 1,000. So we just fill in the difference in the final year. So notice in the declining balance method, different from straight line, is we depreciate more in the early life. Now, why is that prudent? A lot of companies want to write off as fast as they can their assets. And we'll talk about this in business finance. The faster you write off your assets, the quicker you can replace them. And we'll talk more about that in finance, so don't worry about that now. But that's the method of depreciation called double declining. Twice the straight line rate times the cost, and you take the remaining balance every year and whittle that down. All right? Straight line, units of production, double declining balance. Well, let's look at a problem in our textbook so we can practice this. All right? Let's take a look at a problem in our textbook where we can practice this. The problem is on page 388, problem 2-10-2, where we're given 3 methods that we have to calculate, 3 methods to determine that. So let's see if we can put this together. I have a chat question. Oh, all right, Vince, thank you. So let's bring up our spreadsheet here. I lost my spreadsheet, so I better go find it. There it is. First of all, everybody, if you go to week 6 in your file, in your Blackboard file folder for tonight, week 7 for tonight's class, and click on week 7, you'll see in week 7 in-class review a spreadsheet. If you want to follow along with me and do this problem in the spreadsheet format, you can right-click this and download it to your desktop and follow along with me how we do the problem. If you don't want to do that, that's fine. Or maybe you've already done it. You can wait till I'm finished with the problem and I'm going to repost it back to Blackboard, and then you have a template for study and review in future material. So again, it's in week 7, in-class review file folder, week 7, spring 2020, in-class review. You can right-click that and download it, and you can look at it as I follow along. If not, that's fine too. Let's bring up that spreadsheet. And here it is right here. It's a blank spreadsheet. But let's take a look at problem 10-2A and see if we can determine the depreciation schedule. First of all, let's do the basics. What is our cost of our machine? What is it costing us to acquire this machine? Well, it tells us in the problem that it's $257,500. That's the cost of this machine, all right? They tell us in the problem that the estimated salvage value at the end of its life is $20,000. So the salvage value is $20,000. So as we have just seen in our review of the chapter, that means our total depreciable cost that we're going to depreciate over life is the difference, $237,500. That's the depreciable life. Now let me explain that to you a little bit more, because salvage value is kind of confusing. In other words, they tell us that in this project, and by the way, the life of this asset is determined to be 4 years. Let's put that down. The life is to be 4 years, and that's a predetermined by the IRS schedule. By the IRS schedule and how they determine that. So it's 4 years. So how can somebody buy a piece of equipment for $257,500 and all of a sudden assume at the end of 4 years it's going to have a value of $20,000? Okay, and that seems a little bit too crystal ballish for me, but that's how accountants work. Somebody like your purchasing agent, somebody like your CPA firm, somebody like your vendor that you bought the machinery from, if you use this machinery as advertised, as you're supposed to, it's anticipated based on historical value that you'll be able to sell this for 20 G's at the end of its life. Now that doesn't mean it's actually going to be 20,000, but you use that as an estimation now, and then you might have to adjust it later on. So that's all based on estimation. Now the life in years is a different situation. The Internal Revenue Service has a length of time for every asset imaginable. Trust me, every asset imaginable. And in this particular class of asset, it has a 4-year life. So we're asked, first of all, let's determine we're asked to do a variety of different things. So let's set up a chart here. We're going to determine straight line depreciation, if I can spell it right. Straight line depreciation. We're going to determine units of production. That's another method. And they also ask us to do double declining balance. The three methods we just talked about. Double declining balance. So these are the 3 methods. And so we're going to have our year here. So we're going to put together a depreciation schedule for year 1, 2, 3, and 4. Now again, we might own this equipment a lot longer. but the IRS allows us to depreciate over the life of the asset 4 years. All right, so that's what we're going to do. All right, and we're going to use these two methods, and that's called depreciation. Now, in the real world, you have software that does this for you. Have any of you ever heard of a company called SAP? Or any of you ever hear of a company called Oracle up in San Jose? Oracle is based in San Jose, California, or Palo Alto, California. And SAP is based in, I believe, Germany, I think. Those are the two largest accounting software companies in the world. And they have pre-packages of depreciation schedules, and you put your numbers into these schedules and it'll calculate everything out for you. But in Professor Hassey's class, no SAP, no Oracle, we have to do it all. So let's determine our straight line depreciation. And that's pretty easy, all right? It's going to be the same for every year. Remember, our formula was to take the cost, $257,500, subtract out the salvage value of $20,000, and divide that by the length or the life of the asset, which is 4 years. And there we go, $59,375. That's our depreciable life every year. So what we do is just glide that down, and there we go. That's our total depreciation for straight line, $59,375. So if we total all that up, we get $237,500. So if this asset lasts the entire 4 years, we'll depreciate expense $59,375 every year, put that into accumulated depreciation, and then at the end of the life of 4 years, what will the balance be in the account? $20,000. $257,500 cost, $237,500 accumulated depreciation. The book balance is the salvage value, $20,000. Pretty simple. Well, let's use units of production. Now, in units of production, we're told that we have an estimation of 475,000 units during the life of this asset. Well, let's determine what our per unit cost is for that. Remember, the calculation to determine the per unit cost is taking the cost, $257,500, minus the salvage value of $20,000, and dividing it by the estimated amount of units you're going to have over its life, which is 475,000. We get 50 cents a unit. Right? We get 50 cents a unit as our unit cost per unit for units of production. Well, they tell us in year 1, they're going to be actual units produced 220,000 units. So in year 1, we take that 220,000 units and multiply it by the 50 cents depreciable per unit amount. Excuse me. 220,000, that's the number of units used that year, and multiply that times 50 cents a unit depreciable base, we get $110,000 in year 1. Based on that 50-cent rate and the actual units they give us in the problem with 220,000 units. So in year 2, it's going to be now, year 2, they tell us there's 124,600 units produced times that rate, 50 cents, and there's it's 62,003 in year 2. In year 2. Year 3, 121,800 units times 50 cents, $60,900 depreciation expense. And then finally in year 4, they tell us we have 15,200 units times the 50 cents, 7,600 units, $7,600. Oh, something's amiss here, but we'll figure that one out. Let's see what that looks like. So if we sum that up, that's $240,800. Wait a minute, Mr. Hassey. That has to equal 237.5. So we used more units than we planned. So in this final year, we're going to have to adjust this by the number that matches our expected ending book value. And that will be, if I do the arithmetic, $4,300. And then we have our depreciation expense in year 4. Remember, in units of production and straight line, we want to end up with our cost minus our salvage. And because we used more units in year 4 than we anticipated in our original estimate, we have to adjust that down to match our salvage value. So our depreciation expense in year 4 will be $4,300. Clear as mud. Okay. Let's take a look at what our double declining balance calculation would be. Remember, it's twice the straight line rate. What's our straight line rate? Well, it's 4 years. That's depreciating 25% a year. So our double declining balance rate will be double that, or 50%. That's our double declining balance rate. It's 50% because straight line, we're depreciating 25% a year. And then now we're depreciating double that, 50%. So here in year 1, we take the entire cost of the asset. We do not include salvage value. And we multiply that times 50%. And we get our depreciation rate for year 1 under double declining, $128,750. So then in year 2, we take our cost, the $257.5, and we subtract out that $128,750 of what we've already depreciated, and we multiply that times 50%, and we get $64,375. Then in year 3, we take the cost, $257.5, we minus out year 1, $128,750, we minus out year 2, $64,375, and we multiply that times 50%, and we get $32,187.50, and let's round that out to whole dollars, $32,188. So again, remember, we have to make sure that this balances to the total net value of the asset at the end of its life. It's got to equal 237.5. So we got to make sure that this number in year 4 totals out to 237.5. And if I do my arithmetic properly, that should be $12,187. And now that should equal 237.5. So now we have fully depreciated through 3 different schedules this asset. In the double declining balance, we use the original cost and nothing else in the calculation, but we want that to net out to the cost minus the salvage, just like the other 2. Now, our job as the accountant is to determine which one do we want to use. Do we want to use straight line, units of production, and double declining balance? And that depends on how you want to treat this. Do you want to expense more in the early years? Do you want to have it related to usage? Or do you just want to keep it simple and the same amount every year? That's the company culture. That's the company that decides that. Many times the public accounting firm has a say in that. Maybe many times the treasurer or the controller of the company has a say in that. But this gives you 3 alternatives to depreciate your asset. That's problem 10-2A. Any questions? So going forward, you need to be aware of these three calculations. And here's a little spreadsheet to do that. How do you depreciate under straight line, units of production, and double declining balance? You have a question just like that in your quiz to do this next week. So now you know how to depreciate. So tomorrow when you're on a conference call or on remote learning from your company and somebody says, hey, how's accounting going? You're almost done. What did you learn last night? I learned how to depreciate. Wow, you learned how to depreciate? Holy moly. A feather in your cap, learning depreciation schedules. And also this will be a feather in your cap when you take business finance, either this summer from Professor Hasse or somebody else, because one of the first parts of that class is talking about assets and how they create value over time. You have to take into account the depreciation schedule of that asset. And now you'll know what the hell they're talking about in business finance because now you've done it in your accounting class. The three methods of depreciation. Now there's also about 2 or 3 other methods, but they are not as used as much, so we're not studying them here. We will study these 3 in this class. So that's chapter 10. So let's take a break. When we come back from break, we'll take a look at how do we account for turning payables into notes. Kind of similar to what we talked about in chapter 9, turning receivables into notes or turning receivables into collections. But we take a look at it at the different side. We owe money. How do we manage that liability? So we'll tackle that in problem 11.1 and look at a little lecture point on that subject when we come back. And I'll see you guys all in about 10:50. Let's make it 7:10. We'll see you back here at 7:10, 10 minutes after the hour for chapter 11. Okay, everybody. See you then. Bye. Okay, we are back. Before we went on break, Vince had a question. Where do we figure out where every asset's depreciations are found? Where do we figure out where every asset's depreciation are found? I don't really understand the question, but I'm going to guess. Um, you can go to, if you're thinking about how long the life of an asset is, you can go to the IRS tax table, the depreciation schedules for all different types of assets, and they will tell you the life of a various asset. I believe that's maybe, oh, that's what you're, okay, the IRS tables. Okay, very good. That's why we have public accounting firms. They are experts in knowing the tax law because the tax law naturally changes every year, or it has been lately. And so that's why public accounting firms are always in business to handle all that. Okay, good question, Vince. All right, we're now going to talk about debt, current liabilities, accounts payable. We've seen that before. But what happens if we can't pay that debt off on time? We might convert that current liability into a longer term liability. And whenever a current liability goes into a long-term mode, you have interest. You sign a note. It's called a note payable. And you have interest. And that's a key part of determining that. If I have a debt and I can't pay it right away, I might get an extension on that debt, but because I received an extension, I have to pay interest on that debt. And that interest is determining when I will pay. And that somebody says, well, I'm going to need a assurance that you will pay me, so I'm going to charge you interest on that debt. Ugly. What type of liabilities are we talking about here? Accounts payable, sales tax payable. These are all different types of liabilities that could be extended credit over a period of time. Liabilities that do not extend credit are unearned revenues. You have to provide the service. Short-term notes payable, they already have the interest included in that. And payroll liabilities. Payroll liabilities, you got to pay. But if you have a business, excuse me, if you have a business and you have employees, every month you got to send a check to Sacramento or Washington, D.C. to pay the payroll taxes that you've withheld from your employees. We are not going to talk or be responsible in Chapter 11 for payroll liabilities. You're only going to have to be responsible for accounts payables turning in to notes. All right, that's one of the key parts that you need to be responsible for. All right, for example, here's an example. Here's a note on August 23rd, Brady Company asked McGraw to accept $100 cash and a 60-day 12%, ouch, $500 note to replace its existing accounts payable. In other words, they owe this company $600. We can't pay. I'll pay you $100 now, and then I'll pay the balance over 60 days, and I'll give you 12% interest. Jeez, sounds like loan sharking. But how that 12% is determined, it's the ability and your credit involved in this. Maybe this person has lousy credit. And also, it's the cost of money in the market. Right now, money is dirt cheap, so you probably wouldn't see too many 12% note payables, but you never know, especially if you have bad credit. So here's the journal entry. I'm going to debit the accounts payable account, wiping out the accounts payable balance. I'm going to disperse $100 in cash to this Brady company. And then I'm going to assume a note payable of $500 payable in 60 days at 12% interest. So now I'm going to have to pay more than $500 in 60 days. I'm going to have to tack on 12% interest on that. All right. Well, how much interest is 12%? Well, remember the date of this loan was August 23rd. 60 days from August 23rd, September, October is October 22nd. So I calculate my interest by taking the amount of the principal, $500 times 12% and multiply that times the time period of the loan. Now, we assume this is simple interest, so we're going to assume, just for the sake of easy calculations, and the text talks about this, that our number of days in a year are 360. In other words, there's 30 days in every month. Now, that's not the real world, but it just keeps things a little bit simpler. So what percent or 60-day loan divided by 360 is the amount of time this loan is covering? It's a 12% annual rate. So $500 times 12%, all right, times 60 divided by 360. Well, that you can do that in your head. $500 times 12% is 60 bucks. $60 times 1/6, 60 divided by 360 is 1/6. What's 1/6 of $60? 10 bucks. So the interest expense will be debit 10 bucks. And so we now are going to pay off $510 in 60 days. The key reason why we're studying this is not so much for the journal entry, but to understand the calculation of interest over time. You're going to be doing a lot of that in business finance. The cost of money. Accounts payable, all I have to do is pay it off in 30 days. But if I can't pay it off in 30 days, I have to extend that to a note. And because I extend it, I have to pay interest on the time period of that extension. This is a perfect example of that, taken from chapter 11. So, with that being said, let's take a look at page 426, problem 11.1a. Before we do anything else, we're going to determine the maturity date of each one of these three notes talked about in this problem. We're going to determine the amount of interest due at maturity, and we're going to do the amount of interest recorded. Then you are going to determine the journal entries to record these transactions. That's the part I'm going to ask you guys to do. I'm going to do all the rest. I'm going to determine the amount of when the notes are due. I'm going to determine the amount of interest expense due on those notes. I'm going to determine the amount that's going to be accrued at the end of the current year, 2014. I believe it's 2014. And then you are going to determine the journal entry for a problem 11-1. And just for the sake of notation, I'm going to have Kathy do the journal entry for April 20th. I'm going to have Barb Gonzalez to do the journal entry for May 19th. I'm going to have Tori do the journal entry for July 8th. I'm going to have Gabriella do the second part of that July 8th or locust at the maturity date journal entry. I'm going to have Vince do the third part of that July 8th journal entry. I'm going to have Mary Ann do the November 28th entry. And then I will do the December 31st entry. But before we can do those journal entries and give you time for you guys to look at it, I'm going to calculate what's going to be making up that journal entry, the interest involved in each one of these notes. So I'm going to calculate those now and give you guys time to look over those. And as I give you the interest from these different loans on those different dates, you can determine what the journal entry will be to record those transactions. Again, Kathy Campbell, April 20th. Barb Gonzalez, May 19th. Tori, July 8th. Gabriella, the second part of July 8th. Vince, the third part of July 8th. Mary Ann, November 28th. Okay, but before that, let's bring up our spreadsheet. And go to 11.1. And it tells us as we read these transactions, the required part 1 is determine the maturity date for each of these three notes. Well, as you're looking over this problem, we have three different notes. And what are they? We have the note for Locust. We have the note for National Bank. We have the note for Fargo. What are the maturity dates of these loans? Well, let's figure that out. First of all, the very first one. Purchased $40,250 of merchandise on credit from Locust, terms N over 30. On May 19th, technically 30 days later, they replaced that accounts payable with a 90-day, 10%, $35,000 note, along with paying $5,250 in cash. Okay, Barb, that gives you some information for your journal entry. So this Locust note is 90 days. All right. Its maturity date then would be, we take the note out on May 19th. 30 days from May 19th, get a calendar out, is August 17th. So that note is due 90 days after the date of the loan, May 19th, so it's due August 17th. That's 90 days. Let's take a look at the National Bank. We borrowed $80,000 cash on July 8th by signing a 120-day, 9%, $80,000 note payable. Woo. So National Bank has a 120-day note that began on July 8th. What's 120 days from July 8th? 30 days, November 5th. That's when that note is due. And then we have the next transaction, November 28th. We borrow $42,000 cash from the Fargo Bank at 60 days at 8%. So the Fargo note is 60 days. So that's dated November 28th. So 60 days from November 28th goes into the next calendar year, January 27th. So let's put that a little bit, highlight that, because now we know that we're going to cross over into another fiscal year or financial year from November 28th to January 27th. Pay attention to that later on. So that's the highlights of those notes. Maturity, initial date, the date it's due. Maturity in 120 days, date due. That's important to know because that'll be the date of those journal entries when we make those entries. Now, part 2, it says, okay, what is the interest that's going to be due on those loans? We're assuming a 360-day year given in the problem. So how much interest? Well, first of all, it's for $35,000, the Locust loan. Oops. The Locust loan is for $35,000. Right? What is the interest rate? They tell us the rate, the annual rate. Let's put that down. The annual rate is 10%. All right. So that means the time or the period of the loan is equal to, if it's a 90-day loan, is equal to 90 over 360. In other words, it's a 90-day loan as a portion of the total year of 360. So let's determine the interest expense. So we have equals 35,000. Put that in parentheses. 35,000 times 10%, 0.1. Put that in parentheses, and multiply that times the relationship of 90 over 360. That's the amount of time in the loan. We should get, oops, what did I do wrong here? Sorry. There we go. $875. So what I'm doing here now is I'm taking 35,000, multiplying it by 10%. That's roughly $3,500. And then I take 1/4 of that. 1/4, 90 over 360 of $3,500 is $875. That's how much interest I have to pay on this locust loan on August 17th. Let's take a look at the National Bank loan. That amount is for $80,000. Ouch. The annual rate given in that loan is 9%, and the time is 120 days over 360. Again, we use 360 as the base amount of our year. So again, let's do the calculation. Equals 80,000 times the annual rate of 9%, 0.09. And we're going to multiply that times 120 days over 360. We get $2,400. 9% of 80,000 is $7,200 divided by 1/3. What's 1/3 of $7,200? $2,400. That's our interest expense for the National Bank loan that we have to pay on November 5th. All right, let's take a look at the Fargo loan. $42,000. People do this for a living. But again, you have software and templates that calculate this amount out, but it's good for us to know how interests are calculated. You're going to need this when you do take business finances. How do you calculate what is involved in interest calculations? What's the interest rate on this Fargo loan? 8%. The time on this one is 60 days. 60 days over 360. What is the interest expense on this? Again, equals 42,000 times 8%, 0.8, and that's going to be multiplied by 60 divided by, or 60 by divided by 360. We get $560 interest expense for that loan. So that's part 2. The interest on each one of these loans. $875 for the 90-day locust at 10%, $2,400 on the $80,000 loan to National Bank at 9%, and $560 on this $42,000 loan at 8%. All right? In question number 3 on this, and again, this will help you on your calculation, notice this loan, as I said earlier, begins on November 28th, but won't be paid. The $560 is due January 27th. But we have to do an interest calculation because this goes over 2 accounting periods. All right, this goes over 2 accounting periods. So on December 31st, we have to record the accrual of the days from November 28th to December 31st and record those. So what is that accrued interest on the Fargo note on 12/31? They don't give the year. Oh, yes, they do they? Yeah. Let's just say 2019. So what is the accrued interest? Well, remember, the interest is $560. We just calculated that on this Fargo note. But how much is in 2019? Well, from November 28th to December 31st, I believe is 33 days. So it's 33 days divided by 360 days in a year. From November 28th to December 31st, all right, is 33 days. Because there's, all right? So we did, again, we're using simple interest. So now let's calculate how much interest that is. Equals, excuse me, let's say equals 560 560, that's the total amount of interest. And we're going to multiply that times 33 over 60 days. The 60-day note, and in the 2019, 33 days will be used. We get $308. So that's how much is going to be accrued on December 31st, 2019. And on the date that it's due, 1/27/2020, the next year, the balance will be equals 560 minus 308, $252. So you're going to have an accrued entry on December 31st for $308. Then on January 27th, you're going to have interest expense for $250, and you're going to actually pay out the $560 on January 27th. So now we have all the information that you can do to record the journal entries to book these transactions and the appropriate amounts that will be paid on their appropriate due dates and all that. So what I would like you all now to do, Kathy, Barb, Tori, Gabriella, Vince, and Marianne, is now take those particular parts of that problem and give me the journal entries to required to post those entries. Take a few moments. I'll be back to you in about 10 minutes so you can give me those entries and we'll type them right here. Go. Kathy Campbell, whenever you're ready.
Hey, Professor, this is Kathy.
Yes,
Okay,
go.
sorry about that. So we would have, where'd my notes go? So on May 19th.
No, you have the April 20th. You have the April 20th entry.
Oh, I'm sorry. Okay, so on April 20th, we would have the 42, excuse me, the 250
Yes.
as a debit and a credit, and that would be for the merchandise and then accounts payable.
So we debit merchandise inventory,
Right.
40,250, correct?
Yes.
Very nice. And we would credit accounts payable. And we'll call that to Locust. Credit 40,250, correct?
Yes.
Very good. We're recording the liability of accounts payable on April 20th. We have 30 days, it says there net 30, to pay $40,250. And we purchased inventory. Thank you, Kathy. Well done.
Thank you.
That was easy. May 19th, Barbara, whenever you're ready.
Okay, Professor, I'm not sure if I did this correctly, but I have May 19 Locust for credit 40,250.
We're crediting what?
The credit, I mean, the purchase, right?
Well, it says you've already done the purchase. Kathy already did it here.
I could help out, Professor. This is Gabriella.
Well, I want Barb to figure this out. All right. Yeah, I'll ask you for help later, but Barb needs to sort this out. Barb, so what we're doing now is they're telling on May 19th, that's the date of this transaction, that we're replacing this accounts payable with a note payable.
Okay, that would be 35,000 on debt, I mean, credit, right?
Credit what?
The notes payable, right? And that's considered cash?
Well, we're assuming a $35,000 note payable for $35,000 credit. Very good. What else is going on here?
We are crediting the cash of 5,250.
Very good. 5,250. And what do we debit?
We are debiting 875 for the interest, right? The 10% interest?
No, we haven't paid. The time hasn't expired yet. We haven't incurred the interest yet. What does the transaction say? We're replacing the accounts payable with a note.
Of 35,000.
We're debiting accounts payable because we're wiping out that liability and creating a new liability called the note payable. how we're paying 5250. So we're paying 5250 of the 40,250. So we're taking out, remember over here,
Yes.
$35,000 note. Okay?
Okay.
Good job.
Okay.
Okay, Barbara? Good. Very well. That's
Thank
a
you.
good job. All right. July 8th. Tori, when you're ready.
So the is going to be a cash debit 80,000, and then note payable credit 80,000.
Tori got an easy one. Tori got an easy one.
Woo woo.
Very good, Tori. So on July 8th, we're borrowing $80,000 from the National Bank, and we're taking out a note due in 120 days, and we now owe a note payable credit 80,000. Very good. All right. Now the next transaction, it says we're paid the amount due on the locust note on the maturity date. We're paying the amount due on the locust note at the maturity date. Gabriella, what's cooking there?
So what I got was, wait, wasn't I supposed to do the NBR bank? The locust was first?
Oh, you're doing the second transaction there. Tori did the July 8th. You have the second transaction that says unknown date, paid the amount due on the locust note. That's your transaction.
Okay. I think I was a little confused, but what I ended up getting was, well, July 8th as the date. Cash debit.
When, remember we just did this locust note up here on May 19th. Barbara did this. When is this $35,000 due?
May 19th.
What did we do over here? When's the locust note due?
August 17th.
There you go. So on August 17th, you're paying off that 35,000. Go.
Okay, I'm sorry. I did the same one that Tori did. That's what I thought I was gonna do.
No, I said the second one on July 8th, the second transaction.
Okay.
Take your time. I'll wait for you.
Okay, so then I should have done the July 8th where it says paid the amount due on the note to NBR Bank at the maturity date.
No. It says under July 8th, it says question mark. That's the question mark. You have to tell me what the date's going to be. And then it says paid the amount due on the note to Locust at the maturity date.
I see.
Nothing to do with the NBR. It says the Locust note.
Okay. Okay, so let me try this. Okay, so the date would have been August 17th, correct?
Very good.
Okay. So then it would be notes payable for the locust. And would it be debit 35,000?
I think that's pretty good. Yeah.
Okay. And then we also have to include the interest expense.
Very good. How much is that?
Let me do the math real quick.
Well, we did it right over here.
Well, yeah. Okay, 875. Sorry.
And what do we debit? What are we doing there with the 875?
Debit. That would be a debit.
Debit to what?
Debit to the interest?
Interest expense. Very good.
Yes.
$875. And what else we have to do?
We would have the cash credit of the total, which would be 35,875.
Very good. Very good. Excellent. So now on August 17th, as we calculated over here, 90 days from the date of this note, May 19th, we now have to pay $875 additional plus pay back the loan. So we're writing a check for $35,875. Excellent.
Okay, and then we have to do the second one, correct? For the NBR bank?
I have no idea what you're talking about, dear. You got to pay attention here now. That was the only
You said I
transaction
have
you
to
had to
do
do,
both.
Gabriella. The next one is Vince's. Vince has the next transaction.
Got it.
Okay, very good. So
Okay.
Vince, you're up.
Okay. So I have a debit of $80,000.
Oh, wait a minute. What's the date of this transaction?
The date's going to be November 5th.
Very good.
And I have a debit of 80,000 on November 5th.
And what are you debiting?
80,000.
To what account, though?
Notes payable.
Very good. Notes payable. Very good. $80,000. Excellent. What else?
Now we have my interest expense,
Okay.
which is at 9%.
Yeah.
So that's going to bring us to $72,000.
Wow. Didn't we calculate the interest expense over here, Vince?
Yes. Okay, I was multiplying the 80 by the 9%, so that's not the right way.
Yeah.
Okay, so
By the way, 89% of 80,000 is $7,200, not 72,000.
okay, 7,200. All right,
All right.
and for zero. All right.
So what are we doing here?
For the well, we already calculated the interest expense, right? So we already have that. And then next is going to be our cash, which is going to be the 7,200 plus the 2,400. Okay.
We're writing a check to pay off the $80,000 loan plus the interest, $82,400.
Okay. There you go.
Thank you.
Thank you.
No. All right. So here we're incurring this loan here on July 8th for $80,000 to the National Bank. We borrow the money and it's due in 120 days, which we calculated to be November 5th. And here on November 5th, we're paying out or reducing, debiting the note payable. We're incurring the $2,400 interest over those 120 days that we calculated here. And we're writing a check to National Bank for $82,400. Very good. The next transaction, Marianne Lawrence. Marianne. Marianne. All right. No Marianne. Then Professor Hassey will do it. The November 28th transaction. Tells us that we borrowed $42,000 cash from Fargo Bank and signed a 60-day, 8%, $42,000 note payable. So November 28th, we're borrowing 42 pops from Fargo. What's the transaction? We're receiving cash debit, $42,000. And we're incurring a note payable that'll be due in January of the next year to Fargo of $42,000. The liability is now on our books. And then it says on December 31st, and I was going to do this transaction. December 31st, it says recorded an adjusting entry for the accrued interest on the note to Fargo Bank. So on this note, November 28th, November 28th, there it is right there. We have to record an adjusting entry at the end of our business cycle, our business year, December 31st. And what do we have to record? The amount of interest that has been accrued through December 31st. And that's why we did this calculation here. $308. Debit interest expense. $308 and credit interest payable. We owe the money. It won't be paid until January, but as of December 31st, we owe $308 of those 33 days from November 28th to December 31st. That's the adjusting entry to book the interest for those 3 days. Marianne has a chat. I'm sorry, it appears my Amazon special microphone that is less than 2 months old is no longer working. It's all right, Marianne, do not worry about it. Just follow us along here. And remember, never buy from Amazon. They're always going to rip you off. That's tonight's political commentary. All right, let's get back to this transaction here. So we have recorded $308 of accrued interest through December 31st. And there's one more entry to be done here, as you can see in this problem on page 426. Year 2, paid the amount due on the note to Fargo Bank at the maturity date. Well, we calculated here that the maturity date is January 27th. So now we do an entry on January 27th of the next year, let's call it 2020, where we're now paying off the loan and the interest. Well, the interest expense in this new year is going to be the interest expense calculated for these days here, from January 1 to January 27th. That's $252. That's in this new year. That's the expense. We're going to wipe out the note payable as a debit. The note payable to Fargo Bank. We're going to pay off this loan of $42,000. At the same time, we're going to wipe out the interest payable that we did on December 31st for the $308, because we're paying that off too. That was a liability at the end of December. And the cash amount payment would be the $42,000 plus the total interest incurred of $560, $42,560. So now we've properly recorded the interest expense in the 2019 year and properly recorded the interest expense in the 2020 year, wiped out the liability of the loan, wiped out the accrued entry of December 31st that carry forward into the next year, and we write a check for $42,560 to pay off the loan. Ladies and gentlemen, Madame and Messieurs, this is a problem that shows you how to determine the interest and the maturity dates, and then the examples of the entries to record those transactions to incur the note and the liability, and record the expense and the accrual, if it so happens, at the end of December of the fiscal year. Any questions? I would keep this handy for future reference. How to calculate interest, how to book the liability. Here we're converting a current liability into a long-term liability. Here we're borrowing the money long-term. Here we're paying off that short-term liability. Here we're paying off the loan to the bank. Here we're paying off or incurring another loan. Boy, this company borrows a lot of money, and recording the accrual at the end of our fiscal year, and then paying off the loan because it goes into another fiscal year with that transaction. 3 or 4 excellent examples of recording liabilities from current liabilities to longer term liabilities with interest involved. You have to be concerned with determining the maturity dates, the interest, and the journal entries for this transaction. That is chapter 11. Very good. Let's move along.
And Professor, you're going to go ahead and save this to the on Blackboard. Is that correct?
Yes, I indicated that earlier. That's correct.
Okay. Thank you.
Sure. All right. Now, how do we account for corporations? How do we account for corporations? And I gave you a little bit of a snippet of that in my introduction video for tonight's class. Pretty good definition of what a corporation is and what is involved in the equity position of a corporation. Corporations' assets and liabilities are basically the same of what we've been studying, just a little bit more money because corporations are bigger. But the equity section of a corporation is entirely different. Before, we've just studied capital, the capital account. Now we have to keep track of the different types of equity in a corporation. Here's the corporate organization of a corporation. As you can see, if you guys can't see this, somebody yell out, but this is a corporate form taken from your textbook showing that the ownership of a corporation can be privately held or publicly held. Privately held is, if any of you ever watched the show Shark Tank, those guys are private investors, the Mark Cubans of the world. Those are Shark Tank are private investors. They're buying a stake in the company. And that stake is to be paid off over time as the business hopefully succeeds. But what we're concentrating a lot on in chapter 13 is what is called a publicly held corporation. A publicly held corporation has stock. As I mentioned in the introduction video, common and preferred stock. That's how you determine the ownership of a company, is by issuing them stock certificates on them giving you their money. So a corporation is an entity created by an articles of incorporation or law that shows that there is ownership that is publicly held by the public, the market. A privately held company is held by just a couple individuals. We're going to be concerning ourselves with publicly held companies. What are the advantages of being a public corporation? You're a separate entity. You have limited liabilities. For example, if I'm a stockholder in Uber, right, which thank God I'm not, but if I'm a stockholder in Uber, I own shares of Uber. I have bought their shares of stock and they've taken my money and now they've running their business. If Uber gets sued by somebody who gets the coronavirus while driving in the back of a car that Uber is driving, it's happened, trust me. And somebody will sue Uber to be compensated for the loss of employment and maybe the loss of their life because they contacted a virus in an Uber automobile. If Uber gets sold for those reasons, I, as a stockholder, cannot be sued. That's called limited liability. They can't sue me. They can sue the assets of the corporation, but they cannot sue Rick Hassey. That's the advantage of a corporation. Corporations get sued all the time, but the stockholders are not part of that lawsuit. It's an important concept of corporations. Also, with ownership in a corporation, you can transfer your stock at any time you want. If I own stock today in Uber company and I say, you know what, I've had enough of Uber. Tomorrow morning, I can go to my stockbroker and sell that stock in the market. Now, if they've had a couple of lawsuits in the last couple of weeks, that stock might be not as valuable as it was when I bought it. That's my loss. But I can still transfer and sell that in the market tomorrow morning. Another concept of corporations is you assume they have a life forever. General Electric has been in business since 1875. Apple Computer has been in existence since 1984. Facebook has been in existence since 2000. They all are assumed to be continuously always going to be there. Now that also can be something a little bit odd because companies do close. They go bankrupt. They just sell out. Well, that's their choosing. But when you buy stock in a company, you assume you're going to own that stock forever, a continuous life. So that's the relationship of stockholders, corporations. There's also some disadvantages. Lots of government regulations in owning a corporation. A privately held corporation does not have to report anything to anybody. They don't have to tell anybody what's going on. The only time they have to tell somebody what's going on is when they file their tax return. That's it. But with a public corporation, they're required every 3 months to tell the world how they're doing. What's their profits? What's their debt? What's their assets? Who owns the company? They have to do that. That's very expensive. At the same time, corporations are taxed twice. Corporations are taxed twice. They're taxed on their net income, and then after they have their profits and they decide to distribute some of those profits as dividends to their shareholders, when those dividends checks go out to the shareholders, that money is taxed as ordinary income. Now, it's two different people paying the tax. The corporation pays the corporate tax, and the shareholders pay the dividend tax, but the same amount of money is being taxed twice. That's why we have a lot of deductibles for corporations. They get a lot of tax deductions to ease this burden of double taxation. You're going to learn a lot about this summer in business finance. Now, why do we have stock? Because in the governance of the organization, the stockholders are the bosses. Why? They provide the capital for the company. The stockholders select the board of directors. The board of directors select the managers. The managers select the peons like you and I, the employees of the corporation. The stockholder is numero uno. They run the show. Now, technically, the board of directors really run the show, but the board of directors are selected by the stockholders. Here's another chart. Most companies have what is called an organization chart. Stockholders are number one. They usually meet once a year at the stockholders meeting. They send all the responsibility of managing a company to their selected few board of directors. For a not-for-profit, it's called the board of trustees, but it's the same. The board of directors hire the president, and the president has the responsibility of selecting their management team. And that's how that works. This is what a stock certificate looks like. When you buy a share of stock in a company, you get one of these. It tells the world, I own, in this case, the Green Bay Packers. The balance of our discussion is how to record the journal entries for issuance of stock. And here's an example. September 1, Matrix Incorporated issued 100,000 shares of $2 par value stock for $25 a share. This is the journal entry to record the setting up of the equity section of this corporation. Now, if you looked at my introduction video of yesterday, they talk about the par value of a stock. When a company issues stock, they have no idea what the value is. The market sets the value of the stock. How bad they want to buy the stock sets the market price. And we'll talk more about that later on in business finance. So the accountants and the company issues a par value, just a value that they think it's worth. So in this case, Matrix says, okay, the shares have a $2 par value. But once they go into market, they get $25 a share for that stock. So notice how the transaction works. If you take $25 times 100,000, that means they're going to get a cash of debit $2,500. The stock has now been issued to the market. They got the cash. But we record the common stock value at $2 a share. Common stock is now an equity account. $2 times 100,000 is $200,000. This is considered the capital account from what we did prior to this chapter, but now we call it common stock at par. And then the difference between what we received in the market to the par value is another equity account called paid in capital in excess of par. Credit $2,300, $2,300,000. These are the entries to record that on your journal entries. And that's how it's done. So on your balance sheet, you will show two equity accounts, common stock with $200,000 par value and a paid in excess of $2.3 million. It tells the world that we gave a $2 value for this stock at issuance, but the market said, no, we're going to pay you $25 a share because we think we want to own that stock. So the excess over par is another equity account, and we got the cash, $2,500. And again, this is how it shows up on the balance sheet. Common stock in the stockholders' equity section of the balance sheet, $200,000, paid in excess of par, $2.3 million, and now we have a new account called retained earnings. Retained earnings. Retained earnings is where we put our profits, where we close the books to. Remember when we did the closing entry in the midterm? It was closed to the capital account through the income summary. Now that capital account is called retained earnings, where we accumulate all the profits less the dividends in another equity account called retained earnings. That's where you close the books now, revenue and expense, and now it's no longer withdrawals, it's called dividends. And this is what the equity section now looks like for a corporation. When you guys get into business finance this summer or whenever, you're going to look at the financial statements of corporations, and it'll be just like this. Par values common stock, paid in excess of capital, and retained earnings. We need to review that. There's dividends involved in corporations. Those are like withdrawals from our prior classes. So this is the detail that you need to study in chapter 13. We have a question from, I believe, Barbara. Okay, Barbara, no problem. That's okay. See you next week. Okay, so problem 13.2 is practicing these entries. Problem 13.2 is practicing these entries. So let's take a look at that. Oh, here it is. I'm looking all around for it, and there it is. Here's problem 13-2. And it talks about the recording of dividends and a new type of stock that we haven't seen yet called treasury stock. Treasury stock is very important because it's an equity account with a debit balance. What that means is the company is buying back their stock from the market. All right. Remember in our transaction we just saw that common stock is always a credit when we issue the stock. But many times companies buy back the stock. It's called treasury stock. And when they buy it back, they write a check to the market, to the shareholders, and repurchase the stock back. And they put it in what is called their treasury. It's reducing the amount of outstanding shares of stock in the market, and they call it a debit balance to an equity account called treasury. That is done a lot these days in the real world. Companies invest in themselves by buying back the stock. And then here's an example of issuing a dividend. We take the money out of retained earnings, debiting retained earnings, and we credit a liability. We now are going to pay a $2 dividend on 36,000 shares. And then that's the date of declaration. And then when we actually physically cut the checks, we'd wipe out the liability and write a check for 72,000. Retained earnings is reduced, the profits are reduced because we're distributing those profits to the shareholders. There's two transactions, a declaration date when the board of directors announces the dividend and the date that the dividend is paid, called the pay date. So if any of you ever get dividend checks, that's how it works. It's declared by the company and then they pay it on another date when they actually send you the check. So that's corporate accounting. That's chapter 13. We're going to talk a little bit more about this next week. But I want you to do some practice problems this week in a quiz. And that quiz is already posted to Blackboard. And here is what this quiz looks like. Let me bring it up. Up there. Sorry. So I give you a quiz this week where I ask you to practice. Remember, these problems only weigh 5%. They're just practice to practice this like we did tonight with that chapter 11 problem. We practiced it. So what we're going to do is we're going to practice these this week. Right here. And this is what's posted to Blackboard tonight, and it's due this coming Sunday at 9 o'clock. If you need some extra time to do it, just let me know. That's not a problem. So you're going to do a bank reconciliation just like we did last week from chapter 8. You're going to do chapter 9 receivables that we did last week about the allowance for doubtful accounts. Remember that? And then you're doing a problem from tonight, recording the depreciation for 5 years for this asset of $90,000. You're going to determine the schedule for 9 years of depreciation for 5 years of depreciation under straight line and units of activity. So you're doing 8, 9, and 10 practice next week. And then when we come back next week, we're going to look at further chapter 13 and look at some more problems along with that. And then we're going to talk about chapter 18 and 19. Chapter 18 and 19 has to do with managerial accounting, and job order costing. And I just want you to read a certain amount of pages in those chapters, and I'm going to give you those pages now. In chapter 18, notice we're skipping a bunch of chapters, which is kind of a good thing. In chapter 18, the name of the chapter is Managerial Accounting. How to use accounting to make strategy and managerial decisions. You're going to read from page 651 and learn about fixed and variable costs. And you're going to read to page 662. 651 to 662 in chapter 18, the definition of managerial cost accounting. Then in chapter 19, which talks about more detail involved with managerial accounting, it's called job order costing. And this is really going to flip you out, but you don't have to read too much here. You're going to read from page 687 in chapter 19, and you're just going to read through page 696. 687 to 696. That's your responsibility for chapter 19. We're going to review chapter 13, 18, and 19 next week in our class on Monday night. Try that quiz. It's practicing problems that we did last week, reconciliation and accounts receivable. And what we did tonight, problem 10-2A would be a good practice for that. I'm going to post that file right now at the end of our class to week 7 file folder in class review. So that's what we have for tonight. A little bit longer class and a lot of material, but thank you for bearing up with me. You guys are doing well. We only have a few more weeks to go. Quiz this week, final on May 18th, and our project paper due on the 25th. And we'll talk more about that next week. I didn't have enough time to get at it tonight, but we'll talk about that next week if anybody needs any help with that. All right, everybody, I'll let you go. Thanks for a good class, and we'll see you all next Monday night. And then remember, I do have office hours Thursday nights at 7 o'clock. Thanks, everybody. Have a good week. Be careful.
Professor,
Yes.
thank you.
Thank you, guys. Thank you. Be careful. Be safe.
Thank you, Professor. Appreciate it.
Kathy, you take care.
You too.